The Turkish lira slumped to an all-time low, sparking nervousness among emerging market investors and dragging other EM currencies down with it. Diplomatic tensions with Washington, coupled with Turkey's own economic problems, has led to a surge in Turkish market volatility. Joining me now to discuss what's next is Richard Segal, Senior Analyst at Manulife Asset Management. Richard, thanks so much for coming in. So let's start by breaking it down a little bit. What was it that initially catalyzed the sell-off in the lira?
There were several factors. It was initially hoped that after Turkey's recent general elections, there would be a new government prioritizing reform, but instead the cabinet was composed of officials who were perhaps less likely to implement those reforms. In addition, the central bank refrained from raising interest rates during a period of volatility, and that sent a lot of investors to the exits. But beyond that, the administration left a news vacuum, a policy vacuum, and that caused even more exits.
So how do you see this sell-off in the lira playing out? Do you think it could potentially lead to a full-blown economic crisis in Turkey?
Well, to some extent, the economy was already slowing down rapidly because the central bank did raise rates. Its benchmark rate is now 17.75%, one of the highest in emerging markets. However, this was belated, but at the same time it was already causing a dramatic slowdown, which has since been exacerbated. In some senses, the rebalancing that was necessary after overheating and the rise in oil prices is what the doctor ordered, so to speak, but it's causing a lot of concerns about the strength of the banking system. So I guess you could say that the type of rebalancing that Turkey needs could be on the way, but there are still a lot of risks behind the surface.
Now, you mentioned the banking sector there, and I want to move on to that in a second, but I mean, it seems like a lot of the problems are relatively isolated and focused within Turkey. So why are we seeing this contagion effect in EM currencies, especially I'm thinking about the South African rand and the Mexican peso, which have really slumped in recent days?
A lot of these very liquid emerging market currencies are very linked. Often when you see a big move in the Russian ruble, the Turkish lira, the Indonesian rupiah, the rand, or the Brazilian real, it often leads to contagion. It doesn't happen all the time, but once it does happen and once it spreads to 2 or 3 currencies, it can often spread to the rest of them.
And you mentioned contagion there. There was, of course, this report in the FT that the ECB was concerned about the exposure of certain European banks in Turkey, including the likes of UniCredit, BNP Paribas and BBVA. So is there a contagion risk there?
There are 3 or 4 Western European banks that do have the largest exposures. The 2 most significant are BBVA, which has a very large stake in Guarantee Bank, and also UniCredit, which has a stake in Yapı Kredi. Those concerns are real, but for the time being, they are containable. But it is probable that they will have to put capital into those banks. It's right for the ECB to draw those warnings, but I wouldn't over-dramatize the risks at this point.
Okay, and when we think about the domestic financial sector, in your notes you said that while the banking system is directly in the line of fire, the depreciation in the lira won't lead to capital shortfalls. So how come you're not too worried about the banking sector domestically?
Not from the depreciation alone. The rule of thumb is that a 10% depreciation leads to a 50 basis point drop in the capital ratio. Capital ratios in Turkey are extremely high. They are, in many cases, between 15 and 18%. If we consider that they want to have, in terms of total capital, at least 12%, then currency depreciation alone won't cause that shortfall. However, if non-performing loans continue to rise, and they did rise quite a bit in the second quarter, and large corporates ask for restructurings, that could lead to a domino effect. I would reiterate that as long as the crisis is contained, for the time being, there's nothing to worry about. But thus far, the crisis management in the past several weeks hasn't really inspired a lot of confidence, and that's why the concerns have been growing about the banks in the past week or so.
And when it comes to the situation in Turkey, President Trump obviously doubling those tariffs on Turkish steel and aluminium, adding to the problems there. I'm wondering to what extent you think the worsening bilateral relations are harming the economic situation for Turkey.
It's very symbolic, extremely important symbolically because of the impact that it has on the stock market and the currency. But actual direct trade flows between the 2 countries are quite insignificant. In fact, if you look at the Turkish steel industry, the figures that were published this morning suggest that their exports to the U.S. are about 0.7% of their total exports. So the impact of the tariff increase on their exports is close to negligible. Steel is a commodity, so exports that were going to the U.S. could go someplace else. However, as I mentioned, the symbolic effect is very important. So that's why it's very important also for the Turkish government to improve its relations with the U.S. as soon as possible, because investors are watching that.
So what actions do you think need to be taken in order to reinstate financial stability within Turkey? Because we know there's a reluctance from President Erdogan to raise interest rates. Is that what needs to be done? Do you think possibly Turkey could go to the IMF?
There's 6 or 8 things that could be done. Among these are, as I said, improving bilateral relations with the U.S. As almost everyone knows, except maybe the President, raise interest rates, introduce a structural reform program, take action to shore up the banks if necessary. In other words, the same types of commitments that were made in 2001 during a banking crisis, but also during 2008, 2009 during the global financial crisis. I don't think going to the IMF will help that much, because the IMF would demand the same things that Turkey needs to do by itself, and they don't really need the IMF money. They really need policies rather than money, and capital controls wouldn't work because Turkey is such an informal economy. There are so many informal cross-border flows from Iran and back, from the UK to Turkey and back, that capital controls themselves, I think, would be self-defeating.
Now, President Erdogan, we know he's appointed his son-in-law, Mr. Albayrak, to the finance ministry. Do you think he's up to the task of dealing with this crisis?
It's too soon to tell. He's a very successful businessman. He's very well educated. The speech that he gave last Friday in a vacuum was just what the market needed, but it came just after his father-in-law gave a speech which was just what the markets didn't want to hear. It was very long on Turkey, on what Turkey needs to do, but it was very short on specifics. It could be that they're still formulating a plan. It could be that he and others in Turkey are negotiating with Kuwaitis, with the Qataris, the Chinese, and elsewhere in order to attract financing, and they don't want to say too much right away. Or it could be just that they are trying to do everything they can, and if it is necessary to impose an austerity program, that's what they will do, and that they're just buying for time.
And finally, what does the Turkish situation mean for emerging market investors? Is it time to step away?
I think because conditions are very thin in August anyway. We're virtually 20 years to the date from the Russian crisis. In fact, 20 years less 4 days. Because it's August alone, I would say remain on the sidelines. In addition, as I mentioned before, when one emerging market currency takes a bath, others tend to follow. You tend to have outflows from emerging currency funds, and that tends to lead to forced selling. But I think there should be a lot of clarity by the first or second week of September. Valuations will be quite attractive again. So not too long to wait, but still a little longer to wait.
All right, Richard, thanks so much for your time.
Thank you.
That was Richard Segal, Senior Analyst at Manulife Asset Management. Thanks so much for watching IGTV. I'm Victoria Scholar, and we'll see you very soon.
Subscribe to IG for educational content, company insight, financial analysis, and expert commentary.